Okay, so let's jump into this deep dive. I think a lot of people listening probably feel this way, right? That building wealth, even just saving for a house, it just feels so much harder than it maybe was for, say, our parents' generation.
Yeah, it's definitely a common feeling, and the material we looked at really put some numbers on it.
Right, like the housing example, it's pretty stark.
It really is. Back in the 1970s, getting a modest home might have cost something like, what, 2 years of an average salary?
Yeah, around that. Manageable, you could sort of see a path.
Exactly. But fast forward to today, and you're looking at potentially 6 years of salary, maybe even more for that same kind of house. It's a completely different scale of challenge.
So what happened? I mean, that's a huge shift.
Well, the sources point pretty clearly to a major pivot point back in 1971.
Oh, okay. Nixon and the gold standard.
That's the one. When the U.S. dollar was officially, decoupled from gold. Before that, there was at least a theoretical link. The amount of money printed was sort of anchored to gold reserves.
Sort of anchored, yeah.
But ending that link, well, it fundamentally changed the nature of money. It meant that the supply of dollars, what we call a fiat currency now, could be expanded basically based on policy needs, not a physical constraint like gold.
And the knock-on effect of that.
Yeah.
It sounds pretty fundamental.
Oh, it's huge. The data shows that since 1971, the U.S. dollar has lost, well, something like 97% of its purchasing power.
Wait, say that again? 97%?
97%, yeah. So what cost you $1 back then, you'd need well over $20 for today.
Wow. That's hard to even get your head around. And it's not just houses, is it?
Not at all. It hits everything. It just slowly, or sometimes not so slowly, erodes the value of any savings you have. And it makes those really big-ticket items, think college tuition, healthcare costs. It makes them feel almost insurmountable for a lot of people.
Which I guess leads us to the core question the sources were exploring, right? If traditional money, fiat currency is sort of designed to inflate, to lose value over time,
then are there other assets that work differently?
Yeah.
Exactly. And that's where this deep dive really focuses on Bitcoin.
Okay.
Because Bitcoin is presented in the material as something designed quite differently, specifically designed to potentially resist that kind of devaluation and maybe even increase in purchasing power over time.
And that comes down to scarcity?
Primarily, yes.
Yeah.
It's built around this idea of hard digital scarcity. There's a fixed limit. Only 21 million Bitcoin will ever exist. Full stop.
Which is just fundamentally different from currencies where more can always be created.
Completely different.
Yeah.
And it's not just the limit, it's the issuance schedule, too. Things like the halving events. The most recent was April 2024 they're programmed in.
Right, that cut the rate of new supply.
Yeah, it's a built-in, predictable, disinflationary mechanism.
Mm-hmm.
It slows down how many new coins enter the market over time. It's sort of like mimicking digitally how finding new gold gets harder and harder. That scarcity is really key to its whole value proposition.
And you don't need to buy a whole one, right? That's important too.
Oh, absolutely crucial. Bitcoin is incredibly divisible. One Bitcoin breaks down into 100 million smaller units.
Satoshis are sats.
Sats, exactly. So you can buy, $10 worth, $50 worth, and own thousands or tens of thousands of Satoshis. The barrier to entry isn't owning a whole coin. It's just participating at whatever level you can.
Okay, but let's talk about how rare owning even some Bitcoin actually is, because the numbers cited were pretty striking.
They really put it into perspective. So the data mentioned from early 2025 showed that fewer than 1 million wallets actually held one whole Bitcoin or more.
Fewer than 1 million? Globally?
Globally. Around 992,000 wallets, the figure was. Now think about that compared to a global population heading towards 8 billion people.
That's tiny. What does that work out to?
It's incredibly scarce. Roughly just over one person in every 8,000 globally. And remember, one person can have multiple wallets, so the actual number of people holding a full Bitcoin could be even smaller.
Wow. Okay, 1 in 8,000. So even owning, say, a tenth of a Bitcoin 0.1 BTC, that starts to sound pretty significant then.
It really does. According to those same stats, only about 4.5 million wallets held 0.1 Bitcoin or more.
4.5 million wallets.
Yeah, relative to 8 billion people, that's still only about one person out of every 20,778, roughly. So even owning 0.1 BTC puts you in a statistically pretty small group worldwide.
It really highlights that contrast we started with, doesn't it? Fiat supply can expand, potentially massively, but the Bitcoin supply is fixed, known, predictable.
That's the core difference. And that's why the sources suggest it could act as a hedge against that steady loss of purchasing power we see with inflating currencies. The idea is, as fiat potentially buys less over time.
An asset with genuinely fixed scarcity, if demand for it keeps growing, might actually buy more.
Precisely. Now, it's not saying the price won't bounce around. Bitcoin is famously volatile. We know that.
Sure.
But the argument is about the long-term trend, that its fundamental properties, the scarcity, the network effects, growing adoption, maybe by institutions or even nations, could drive its relative value, its purchasing power, upwards over decades compared to currencies designed to inflate.
And those analyst projections for 2025, they sort of paint a picture of what that could mean.
Well, yeah, they range quite a bit. Obviously, projections always do. But many of them suggested price levels that would make holding even that 0.1 Bitcoin today look pretty substantial in hindsight. It's a powerful thought, isn't it, about where value might lie in a digital future.
It is. But there's a crucial disclaimer that came up repeatedly, too.
Absolutely. Diversification. Every source stressed this. This isn't, advice to go all in on Bitcoin. Definitely not.
Right. Don't put all your eggs in one basket.
Exactly. It's more about recognizing that if traditional currency is losing value, one potential strategy might involve allocating some portion of your savings or assets towards something with fundamentally different properties, something scarce.
Okay, so wrapping this up then, maybe the final thought for you listening is this. If we accept that traditional currencies have been, steadily losing purchasing power for decades, and digital scarcity offers a potential counterforce, just maybe, how does that possibility reshape how you think about saving, how you think about building value, financial security for your own future?
Yeah. Something to definitely mull over.